Standard life insurance provisions. Entire contract. The entire contract includes the actual policy and the application. It states that nothing outside of the contract includes the signed application, and any attached policy riders, can be considered part of the contract. It also assures the policy owner that no changes will be made to the contract or waive any of the provisions after it has been issued, even if the insurer makes policy changes that affect all policy sales in the future. This, however, does not prevent a mutually agreeable change or modifying the contract after it has been issued. Any change to a policy must be made with the approval of an executive officer of the insurance company, whose approval must be endorsed on the policy or attached in a rider. We can't send you additional paperwork later. The entire policy and application is sent to you, and that makes up your entire contract. The execution clause states that the insurance contract will be executed when both parties, the insurer and the policy owner, have satisfied the conditions of the contract. The privilege of change clause, or policy change provision, outlines the conditions under which the company will allow the policy owner to change the policy's coverage. Insuring clause, or insuring agreement. The insurer's basic promise to pay specified benefits to a designated person in the event of a covered loss. The insuring clause is the part of the insurance policy that identifies the specific type of benefits or services that are covered by that policy and the circumstances under which they will be paid. The purpose of the insuring clause in an insurance policy is to specify the scope and limits of the coverage provided. Any promises the insurer makes will be in the insuring clause. Consideration clause. A policy owner must pay a premium in exchange for the insurer's promise to pay benefits. A policy owner's consideration consists of completing the application and paying the initial premium. The amount and frequency of premium payments are contained in the consideration clause. In insurance, the insurance company exchanges the promises in the policy for a two-part consideration from the insured. Consideration is an exchange of something of value on which a contract is based. An insurance contract is valid only if the insured provides consideration in the form of the initial full minimum premium required and the statements made in the application. The applicant begs, "Please consider me for insurance. Here is my completed application, my initial premium, and how much money, how often I agree to pay. Please consider me." Incontestable clause. The clause in a life insurance contract that prohibits the insurer from questioning the validity of the contract after a certain period of time has elapsed. Typically 2 years from the policy's issue date. If your state is different, we will cover that in the state law portion at the end of the course. Physical exam and autopsy. The physical exam and autopsy provision entitles a company, at its own expense, to make physical examinations of the insured at reasonable intervals during the period of a claim, unless it's forbidden by state law. Forget everything you learned on Law and Order. Only the state can forbid an autopsy. You gave up your and your family's rights to refuse when you applied for insurance. Misstatement of age or sex allows the insurer to adjust the policy benefits if the insured's age or sex is misstated on the policy application. The misstatement of age provision allows the insurer to adjust the benefit payable if the age of the insured was misstated when the application for the policy was made. The insurer can adjust the benefit to what the premiums paid would have purchased at the insured's actual age. If the insured were older at the time of application than is shown in the policy, benefits would be reduced accordingly. The benefits would be increased if the insured were younger than listed in the application. Owner's rights provision defines the person who may name and change beneficiaries, select options available under the policy, and receive any financial benefits from the policy. Assignment provision. The assignment clause or provision is the right to transfer policy rights to another person or entity. The new owner is known as the assignee. An absolute assignment occurs when the assignee receives full control of the policy and rights to the policy benefits from the current policy owner. Under an absolute assignment, the transfer is complete and irrevocable, and the assignee receives full control over the policy and full rights to its benefits. A collateral assignment is the partial and temporary transfer of rights to another person or entity. Collateral assignments are usually intended for securing a loan with a creditor. A collateral assignment occurs when the policy is assigned to a creditor as security or collateral for a debt. If the insured dies, or sometimes becomes totally permanently disabled, the creditor is entitled to be reimbursed out of the benefit proceeds for the amount owed. The insured's beneficiary is then entitled to any excess of policy proceeds over the amount due to the creditor. Free look. The policy owner is permitted a certain number of days once the policy is delivered to look over the policy and return it for a refund of all premiums paid. Grace period. A specified period of time after a premium payment is due, during which the protection of the policy continues even though the payment for the renewal premium has not as yet been received. If the insured dies during the grace period of a life insurance policy before paying the required annual premium, the beneficiary will receive the face amount of the policy less any required premiums. The purpose of the grace period is to give the policy owner additional time to pay overdue premiums. The policy owner is given a number of days after the premium due date. During this time, the premium payment may be delayed without penalty, and the policy continues in force. The grace period is the same definition for your insurance bill as it is for all of your other bills. Don't pick it as an answer if the question isn't talking about paying your bill late and keeping your insurance. Reinstatement permits the policy owner to reinstate a policy that has lapsed as long as the policy owner can provide proof of insurability and pays all back premiums, outstanding loans, and interest. Most states allow reinstatement up to 3 years after a policy is lapsed. However, some states are 5-7 years. The reinstatement provision specifies that if an insured fails to pay a renewal premium within the time granted, but the insurer subsequently accepts the premium, coverage may be restored. Under certain conditions, a policy that has lapsed may be reinstated. Reinstatement is automatic if the company or its authorized agent accepts the delinquent premium, and the company does not require an application for reinstatement. If it takes no action on the application for 45 days, the policy is reinstated automatically. To reinstate any policy, you need a reinstatement application, statement of good health, all back premiums, provisions and options related to cash value. Non-forfeiture options. When a policy owner decides he does not want his life insurance policy anymore, he has the option to surrender his policy. If there is cash value remaining, the policy owner must use one of the following non-forfeiture options. Cash surrender allows the policy owner to receive the policy's cash value. The policy owner no longer has coverage at this point. Usually, the maximum length of time a life insurance company may legally defer paying the cash value of a surrendered policy is 6 months. Delayed payment provision. Extended term option permits the policy owner to use the policy's cash value to buy level, extended term insurance for a specified period. No premium payments are made. The coverage provided with the extended term non-forfeiture option is equal to the net death benefit of the lapsed policy. Reduced paid-up option. The policy owner pays no more premiums, but the face amount is decreased. You are closing your account, surrendering your policy. What do you want us to do with your cash so you don't forfeit it? Policy loan provisions. Policies that have cash value also have policy loan and withdrawal provisions. These policies must begin to build cash value after a certain number of years. In most states, this is 3 years. Policy loans with interest cannot exceed the guaranteed cash value or the policy is no longer in force. The policy owner has the right to the policy's cash value. Policy loans are not taxable. Any loans with interest due at the time of death will be deducted from the insured's policy proceeds. Automatic premium loans. It allows the insurer to automatically use the policy cash value to pay an overdue premium. Therefore, it allows the insurance company to deduct the overdue premium from an insured's cash value by the end of the grace period if a payment is missed on a life policy. There is no cost for this provision. Automatic premium loans is similar to using a savings account for overdraft protection, but there's no fee, just interest for borrowing your money. If you don't pay it back, interest is added to the loan. Outstanding loans are subtracted from any death benefit or cash surrenders if not paid back first. The insurance company can automatically take out a loan for you against your cash value to cover your premium in the event they don't receive payment from you. Automatic premium loans can continue for as long as the insurer does not receive payment and the policy owner has cash value remaining in the policy. Once all of your cash value is gone, if you don't start paying, your policy will lapse. Automatic premium loans function in the same manner as any other cash value loan. Provisions and options related to policy proceeds. Beneficiary designation, where the policy owner indicates who is to receive the proceeds. Change of beneficiary. The policy owner may change the beneficiary designation at any time unless a beneficiary has been named irrevocable. Settlement options. The ways in which the policy proceeds can be paid out or settled. Typically, the beneficiary chooses the settlement option at the time of the insured's death. The spendthrift clause stipulates that the policy owner may select a settlement option at the time of application. Accelerated benefits rider. It allows the insured to receive a portion of the death benefit prior to death if the insured has a terminal illness and is expected to die within 1-2 years. Whatever amount is withdrawn in an accelerated death benefit will decrease the death benefit when death occurs. Accelerated benefit. Your doctor said you would die soon, so you aren't going to stop paying your insurance, since you know you'll need it soon. The insurance company now knows you're going to die soon, which means they are going to have to pay out the benefit. To make things a little easier and less stressful, they will give you some of the proceeds now and deduct from what would go to your beneficiary at your death. Long-term care rider. A long-term care rider is a type of accelerated benefits rider that will pay a benefit if the insured is permanently confined to a nursing home and requires long-term care or is unable to perform 2 or more activities of daily living. Activities of daily living (ADLS) include eating, dressing, toileting, continence, walking, ambulation, transferring, or taking medication. Provisions and options related to policy dividends. Dividends. Participating policies pay dividends to policy owners if the company's operations result in a divisible surplus. Dividends are a return of overcharged premiums and are therefore not taxable. Insurers typically pay dividends on an annual basis. Dividend options. The following dividend options are available to policy owners for settling dividend payments. Cash option. Take the cash, it's your money. You can take it and run. Reduced premiums option. Reduces premium payments. Just keep them, and next year don't charge me so much. Accumulate interest option. Allows dividends to accumulate interest. Interest is the only part of a potential dividend for which the policy owner may be taxed. Paid-up additions option. Purchase single payment whole life coverage. 1-year term option. Purchase 1-year term protection. Unlike non-forfeiture options, the policy remains active when a dividend option is selected. Life insurance policy riders. Waiver of premium rider. It allows the policy owner to waive premium payments during a disability and keeps the policy in force. It does not provide cash payments to the policy owner. The disability must be total and permanent and have sustained through the waiting period, 90 days or 6 months. After a certain age, usually 60s or 65, the waiver of premium rider is void unless it is currently in use. The waiver of premium covers the primary insured, not any additional insureds. It does not provide income, is not a loan. The insurance company is waiving the premiums. It's just as if the insured made the premiums every month. Accidental death benefit rider, double indemnity, may be added to a permanent or temporary life insurance policy. Pays an additional sum to the beneficiary if the insured dies due to an accident. The amount paid is a multiple of the policy face amount, such as double or triple the original benefit. Truly the cheapest way to add a lot of coverage for a period of time. provides an additional amount of insurance, usually equal to the face amount of the base policy if the cause of death was an accident. Accidental death and dismemberment rider may be added to a permanent or temporary life insurance policy. Pays benefits for dismemberment and accidental death. Pays a principal sum, face amount, for loss of both hands, both arms, both legs, or loss of vision in both eyes. Pays capital sum, 1/2 face value, for loss of 1 foot, 1 hand, 1 eye, etc. 1 foot and 1 hand 100% face value. Guaranteed insurability option rider. It allows a policy owner to purchase additional life insurance coverage at specified dates without providing evidence of insurability. Permits the policy owner to buy additional permanent life insurance coverage at specific points of time in the future without submitting proof of insurability. It also includes specific events like marriage and births, without requiring the proof of insurability. Usually, the benefit is allowed every 3 years, up to the original face amount of the policy. Also known as future increase option, cost of living rider, allows the policy face amount to be adjusted to account for inflation based on the Consumer Price Index. Payer provision rider. A payer provision is typically attached to juvenile policies. It provides that in the event of death or disability of the adult premium payer, the premiums will be waived until the child reaches the specified age, such as 18, 21, or 25. Payer provision protects the insured in the event the payer dies or is disabled. If the individual paying the premiums on a juvenile life policy becomes disabled or dies, the payer rider ensures that premiums will be waived. Also called the payer clause. Term riders. Term riders allow an applicant to have excess coverage by adding an additional term rider for them to the primary policy. Term riders are an economical way to add a large amount of additional insurance to a permanent life insurance policy. Term riders covering the life of the insured can be level, increasing, or decreasing term. Return of premium rider pays the total amount of premiums paid into the policy in addition to the face value, as long as the insured dies within a specific time period specified in the policy. It also returns premiums to the living insured at the end of a specified period of time, as long as the premiums have been paid. Other insured's provisions. Other insured or dependent riders may be added to a primary policy to cover a spouse or another insured, children, or adopted children. Family plan policies usually cover the family head with permanent insurance, and the coverage on the spouse and children is term insurance in the form of a rider. A term rider for other insureds is always level term. Adding a term rider is cheaper than every family member getting their own policy. For example, the primary policy may be on dad, then mom and the children are riding on attached to dad's policy as term riders. Term riders allow for additional family members to be covered under one policy by attaching everyone to the primary policy. Child term rider. A child term rider is a life insurance product that rides on the primary parent's policy and covers the lives of the children. The child term rider is typically one flat premium, regardless of the number of children covered. Remember, a child term rider pays a benefit to the beneficiary parent if the child dies. It does not pay the child. Spousal term rider. A spousal term rider is a life insurance product that rides on the primary policy and covers the life of the primary insured spouse. Remember, a spouse term rider pays a benefit to the beneficiary, primary insured, if the spouse dies. It does not pay the spouse. Common exclusions or restrictions. Exclusions. A feature of a life insurance policy stating that the policy will not cover certain risks. Exclusions and restrictions are situations or conditions which are not covered or covered with substantial limits. The exclusions section is not included in the policy face, first page of an insurance policy. War or military service. The insurer will not pay the claim if the insured dies or is injured while in active military service or due to an act of war. Aviation. The insurer will not pay the claim if the insured dies due to involvement with aviation. Typically, this is limited to high-risk aviation, that is, stunt pilot, instructor, student pilot, a military pilot. While uncommon, it may also include while the insured is serving as a pilot or crew member of an aircraft. Hazardous occupation or hobby. If the insured dies as a result of a hazardous occupation or hobby, the insurer will not pay the claim. To deny the claim, the activity or occupation for which the claim is being denied must be explicitly excluded in the policy, that is, part of the entire contract. The change of occupation provision allows the insurer to reduce the maximum benefit payable under the policy if the insured switches to a more hazardous occupation or reduce the premium rate charged if the insured changes to a less hazardous occupation. Criminal activity. Losses due to injuries sustained while rioting, committing a felony, or attempting to do so also may be excluded. Illegal occupation. The illegal occupation provision specifies that the insurer is not liable for losses attributed to the insured's being connected with a felony or participation in any illegal occupation. Intoxicants and narcotics. The insurer is not liable for any loss attributed to the insured while intoxicated or under the influence of narcotics. Suicide clause. The policy will be voided, and no death benefit will be paid if the insured commits suicide within 1-2 years from policy issuance. The primary purpose of a suicide provision is to protect the insurer against the purchase of a policy in contemplation of suicide. Waivers for impairments. When an insurance company does not cover a loss due to a specific condition the insured has, this is usually called an impairment rider. If the insured's condition improves, the company may be willing to remove the waiver. North Carolina